One renowned retirement expert and former Goldman Sachs banker is stepping forward and revealing his number one way to beat inflation. It's a way to receive a nearly 10% yield from the government with virtually no risk. Folks who take the three simple steps he's sharing right now could receive nearly $1,500 from the US Treasury in as little as a few months. Best of all, it's guaranteed by law, and you could pay zero taxes on this low risk investment. Consider how rapidly inflation continues to soar. You don't want to waste any time missing out on the potential profits he believes are in store for this investment. To get a copy of his new free report with all the details, simply go to beatinflationreport.com. Again, that's beatinflationreport.com for a free copy of his new report. Welcome, Making Money. This is Matt McCall. Thanks for joining me. It's Tuesday, the 7th of June, 2022. A little bit of a different background. For the next 2 weeks, you will see a different background because I'm down in my second home of Nicaragua. Many of you have watched me. I have shows down here in the past. So we got this beautiful painting of a boat, which looks like every other boat that's right outside the window here for the fishermen that go fishing every morning. So we're got a big show coming up today. We have the markets down today after another warning from Target. That's right, another warning. Two stocks down, pulling back. Amazon, retailers falling on that. Apple, it's a WWDC. I'll tell you what that means and some big announcements that came up yesterday and why the stock's moving on that. And then, are we at a bottom, folks? We're going to talk about that. And four stocks that I think are at a bottom. I may not be calling a market bottom, but I got four stocks that I think have hit lows and will be going higher. All that and more coming up right now on Making Money. Again, this is Matt McCall. Thanks for joining me. It's June 7th, 2022. And we got a big show for you coming up. And like I just mentioned, we are here live in Nicaragua with the beautiful little boat here behind me in the screen. And if you see me squirming around like this, there is a reason for it. I don't have ants in my pants, as my mom used to say. I hurt my back swinging a golf club. That shows your age, folks. But I could barely put my shorts on this morning, so it was quite the struggle. So if you see me moving around, that's why. Nothing more than that, because I got to tell you, getting old and getting a back problem is not fun, especially down here in Nicaragua when all I want to do is surf and play golf. So the good part is that means I'll be working 24/7 because I can't do anything else. So that's very good for all of you. There's a lot of good stuff coming your way. But let's talk about the markets here really quick. And as I mentioned, Target was the big news, symbol TGT. That was a big news this morning. Once again, saying they're going to try to get rid of their inventory because they want to clear it out. They're going to lower prices, which is going to bring their margins down even further. And that is taking a real toll on the stock. So let's pull up that stock right away and take a look at it, because I think it's important to get an idea of what's going on with Target, one of the country's largest retailers. As I mentioned, it's almost TGT. You can see on that news right now, we're about 30 minutes into trading. So 10 o'clock East Coast time, 8 a.m. Nicaragua time. It's down about 3.6%. When the news came out this morning, it was down about 7%. You can see here it's on the high of the session. Again, we're 30 minutes in, folks. A lot can happen in the next few hours. But it's almost kind of telling me that it didn't break the low down here from a week and a half ago, that maybe a lot of this negative news has been priced in. And what I find interesting about the Target story is twofold. One, that they came out and warned again just 2 weeks after reporting some pretty ugly numbers. So it's pretty quickly that things get that dire that quick. That kind of is weird to me. The other thing that really kind of catches me is they talk about inventory, wanting to get rid of inventory. And on the other side, you hear a lot of time is supply chain. I can't get inventory. But Target's saying they want to get rid of inventory. What happened was, and this is what led to a lot of the port congestion that we saw in Los Angeles and other places around the world, is when COVID happened, the supply chain was completely disrupted. So a lot of the companies, especially retailers, started doubling up on orders, and all these orders started coming in. So now they had so much inventory, they have to lower prices, and that lowers margins. I said this a little while ago when Target came out and warned 2 weeks ago. I'm not buying Target then. I'm not buying Target now. We're recommending it. Nothing is a recommendation to buy or sell. You always know that. But I'm not buying it here. And what I will tell you about Target right here is this action, though. The way that the stock's acting right here, I think that we, again, could have a lot of stuff priced in. And long term, they're going to be putting stuff on sale, not rising prices with inflation, but likely putting things on sale, getting rid of it. They're going to keep that clientele. So when things do get a little bit better, you will see them come back and inflation comes down. And Thursday, we have the inflation number. So Thursday's show is going to be a lot about inflation. So get ready for that. Well, the number Thursday morning. So again, folks, keep in mind when it comes to a lot of the news that we see here, it might be priced in. We know inflation. We know the inventory's issues with Target. We know what's going on. We know margins a little bit less. So a lot might be priced in. But again, I'm not calling a bottom in anything right now in the market. And speaking of which, let's take a look at this SPY, the SPY, which is the S&P 500 ETF. Right now, we're down about 0.44%. Again, near the high of the session, so bouncing a bit off the lows. So we'll call it, 0.4 to 0.5% on the downside. But keep in mind, we've had a big rally here, as you can see, a real big rally off the lows. And that brings me to my next point I want to talk about. And that is the rallies that we've seen here in 2022. We've seen now 3 rallies of almost 9%. One is about 8.8%. From January 24th through February 8th, we rallied 8.8%. Then we came back down. Then we rallied 12.8% from February 24th through March 29th, pulled back down. And the most recent rally, which was from the 20th of May through the 2nd of June, rallied about 9.7%. So all these rallies, you can see that they're right here. Is rally number 1, rally number 2, and rally number 3. The first 2 rallies were met with new lows. So if this trend continues, we would see new lows and the S&P putting it down around 3,700 likely, if not lower. I don't know if that happens. I think there's a lot of things that could go wrong, and I think a lot of things that could go right in the next couple of weeks and next couple of months. So it is a summer month. It becomes a little more volatile, a little less liquid. At this point, again, I'm not calling the bottom in any stocks. I still think if you're in a retirement account or if you have some type of setup where you're continually putting money away, don't stop doing that, because buying like this, it's dollar cost averaging, and that's what makes you so successful as a long-term investor. You don't stop and don't try to pick the bottom, because it's not going to happen. So that's where we stand with the market right now. We're kind of unfortunately in no man's land. Again, I think a lot of stocks look good right now, but we're basically in no man's land as far as the overall market is concerned. The one area that has been getting hit, unfortunately, is Bitcoin. And the price of Bitcoin rallied big just really in the last 72 hours, up above 31,000, about 31,500, back down below 30,000. It was a crazy spike up and pullback. And the reason for the pullback, I believe, this most recent time is I think there's 4 senators or Congress people, I can't remember who it was, that came out and said that they want to put a little more regulation on cryptocurrencies, obviously, aka Bitcoin. And that spooked a bit of people, giving the power over, or more power, not all the power, more power over to regulators. And that concerns me too. I'm anti-big government, so that concerns me a little bit. However, what was kind of lost in a shuffle is all 4 agreed that this regulation should make Bitcoin a viable investment option for investors. And again, that is where the big price targets come in. Because when it comes to Bitcoin, it's a supply-demand issue. I've talked about so many times. 21 million will only ever be mined. A little over 19 million have been mined now. It's about 90%, a little over 90%. Those next 2 million, according to the numbers, won't be mined until 2140. So you're looking at 18 years or so, give or take. So you don't have really supply coming on. And if demand increases because this becomes a true asset class, which I think it is, but if the masses believe it is, you start getting 1% of all investable assets into Bitcoin. This is several $100,000 per coin from 29,000 and change now. So I still see huge upside. The volatility, even though it's been kind of crazy the last 72 hours, has actually dried up a bit over the last few months in Bitcoin compared to where it's been, even with the pullback. And again, one thing I always say is going back to May of 2020, people talk about inflation when the CPI was at 0.12%. It went up to 8.5%. And again, it comes out on Thursday, the most recent reading. 0.1, 8.5. In that time frame, even with Bitcoin's pullback, Bitcoin is still up 250%. That's a hell of an inflation hedge. Gold up single-digit percent, less than 10%. It's up about 8.5%. So if the gold is the hedge of all hedges for inflation, when inflation goes from 0.12 to 8.5 and it goes up single digits, then you're out of your mind if you think that's the hedge. It's not. And you don't have to agree that Bitcoin is, because it's not one versus the other. I'm just putting it out there because people love to hate Bitcoin too. But in reality, it's actually been a pretty good damn hedge. All right, so that's where we stand with the markets, Bitcoin. Apple this week, they have their what's called the WWDC, the Worldwide Developers Conference. And this is really the biggest Apple software announcement that they have of the year. And a lot of updates came out yesterday. I'm going to go through a couple of them. Some of them don't sound as exciting as others, but I'll go through them all, then I'll circle back. They have the new M2 chip semiconductor, which they had the M1. They have two new laptops coming out with the M2 chips, and a lot of people are saying that that's a really, really important thing, especially for more professional people using Apple computers. They have the Apple Watch that has a new operating system, OS 9, and it's all about health. And I've been saying this for years. The Apple Watch and a large portion of Apple's business will be about health and connectivity. It includes a better sleep function. It has medication and tracker and reminders, tracks your vitamins, better for fitness and running, keeping track of how your pace is, atrial fibrillation tracking. So again, every iteration that comes out of this will add more and more to it, to the point where I believe you'll have your insulin right there. So for diabetics, it's going to be fantastic. The continuation that we are seeing of advancements in healthcare often gets overlooked, and I want to talk about that more maybe next week a little bit, because it's something where you're seeing such innovation and convergence of so many different breakthroughs coming together and helping these mega trends. We talk so much about transportation because you have electric vehicles, you have autonomous vehicles, you have the air taxis that I want to see. We have batteries that are changing everything from boats to planes. Very seeable, very easy to understand. A little bit more touchy feeling. Whereas healthcare, a lot of it's being done in labs and software and AI, and we don't see it as much. So I think we should talk more about that, because you're going to see the way that healthcare is done in this country and other countries around the world will make major strides throughout the roaring 2020s. Also, they came out with the phone now can function as a true webcam. I saw a video where it actually goes up on there. I mean, most people have webcams anyway, but a little better quality. Lots of multitasking stuff for iPads. You can share and be on the same thing at the same time with your coworkers. And a new operating system for Mac is called Ventura. Two other things. One I thought was kind of funny, made me laugh. The new operating system is going to allow you to undo a text message that you send. I'm sure we've all sent text messages that you regret the moment you hit send. You could actually pull it back. Now you can delete it from your string, but the other person, it's in there forever. They could see it, so they could hold it against you. Or you send it to the wrong person. You're talking smack about your boss, and you send it to your coworker, you think, but it actually goes to your boss. That never ends well. So stuff like that. So I thought that was pretty fun. I think it's a great little tool that should have been there forever. It doesn't seem like it's that hard to make that happen. And then the last thing is Apple's getting into what is called now Apple Pay Later, and it's what's called BNPL, Buy Now Pay Later. And apparently, it's a $125 billion business. Affirm is a big player in it. Klarna is a big player in it. Affirm stock got hit yesterday after the news came out, because with Apple coming into it, and they're going to be using Goldman Sachs, the same person they use for the Apple credit card and Apple Pay, to clear this. So what buy now, pay later? If you buy anything online, you probably see Affirm's a big one that's down there, and it says 4 equal payments. So say you're buying a $100 shirt and you want to do 4 equal payments, there'd be no interest for you. It'd be 4 equal payments of $25. However, if you miss the payments or don't make the payments, then it becomes an issue. Then it comes down to the point where you have to pay the interest on it. So it's a big market. I personally don't do it. I use my Amex for everything, but I pay it off. I don't like holding debt. The debt I hold is borrowing at a very low interest rate and buying land down here and other things. That makes sense. But credit card debt, way too high. Not my thing. So Apple stock, let's take a look at it here real quick. It's about a $2.39 trillion company. I look at the forward price to earnings ratio, 22.3, forward price to sales, 5.7. And, it's a little pricier than it has been for a majority of the last 10 years. And you look at the share price, it's unchanged today. It's down a penny. It's literally unchanged right now. So it's not moving much on the news, and it's actually outperforming the market this morning. and it was up a little bit on yesterday's news, but down again from the high of a couple of days ago, similar to the market. Overall, stock's holding up pretty well, in my opinion. It's not highly attractive because the growth rate on both earnings and revenue about single digits, and that doesn't really blow me away. And so it doesn't look as attractive. Do I still think Apple can make huge strides in healthcare? Yes. Do I think Apple can make huge strides in transportation? Yes. And I think it continues to grow. But I think it's in a bit of a lull here that the next big growth spurt probably won't happen for a few years. So you may have a little bit of opportunity cost if you're just trying to buy Apple now. If it's a core holding, I would never sell it. It's not never. Wouldn't be selling it now if it was a core holding by any means. It's pulled back quite a bit. So yeah, I wouldn't be selling it here. But I don't want to run out and just start jumping in Apple at this point. So the last little segment we get into here is I came up with 5 stocks and looking at stocks that I think could have bottomed. And I'm not in the business of picking bottoms, especially in the market. And I shouldn't be in the business of picking bottoms for stocks. But also, I'm looking at for what I consider a sweet spot. And I think a lot of stocks out there I look at are literally 50, 60, 70% off the lows. Granted, they're still down 50%, have a long way to go. But I don't think we break back down the lows that we saw in the last 30 days. So the first one I look at is obviously a very big company as well. And this is Amazon, about a $1.25 trillion company, not a trillion. And Amazon, let's take a look at this. And this is moving on the news of Target this morning. So obviously, retailers, it's moving. It's down about 2.4%. It just had its stock split. It had a 20-for-1 stock split. So if you log into your account and you see the price and think, oh my God, Amazon's down 90-some percent. It's not. It's okay. If you look at it, you'll see that it adjusted for it. And keep in mind, I wrote yesterday in my daily. If you're not a member of the daily, you can sign up for McCall's Daily Insights, free. Every day the market's open, we send it out. And talked yesterday about Amazon stock split because a lot of people has misconception that after the stock splits, it's going to be really good for the stock. It's neither good nor bad. What it does is when you have a 20-for-1 stock split, it creates 20 times more shares, but the price is 1/20th. So it's very simple to figure that out. That if you have 1 share of Amazon, you don't have 20, but the price of the stock is 1/20th when it adjusts. So you end up still having the same amount of money. The company still has the same market cap. The company still has the same fundamentals. It's just the price is lighter now. It's 121 versus around 2,500 where it was. So it's a psychological thing that people think they can buy into the stock cheaper now. It's the same exact valuation. Never, ever, ever look at the share price. Always look at the market cap, the market valuation of a company. That's what's important. The share prices are relevant, folks. I know that sounds crazy, and I'm not going to get deep into it, but trust me, it's what it is. So you look at their forward PE ratio, 46, a little bit higher than Apple, but their price of sales 2.08. And you have growth going forward. I just mentioned Apple was single digits. For Amazon, revenue growth 14% annually, earnings growth 45% annually. And for each of the stocks I'm going to talk about, I have a pretty cool chart here. I'm going to pull up, as you'll see. And this purple line right here, folks, is annual revenue. This is going back 10 years. And then the orange price is the share price. And then the dotted lines are looking out. Obviously, we're not in 2024 yet. Those are estimates. So you can see how revenue did not stop growing. If anything, accelerated in the last 2 years during the pandemic and is expected to continue accelerating. However, the share price came back. This is good. We want to see stocks that the revenue has not slowed down, continues to move up, and prices come down, giving us a great buying opportunity. So that's Amazon. The next one I want to take a look at here is NIO, symbol NIO. And I've talked about this in the past. It's one of the big 3 Chinese electric vehicle makers. The Chinese EV stocks and tech stocks have really bounced back big in the last couple of weeks as China seems to be curbing some of the potential regulations they've been doing. It's a $32 billion company. It's expected to turn profitable in 2024, so just 2 years from now. Its forward price of sales is 2, so that's a very nice valuation for a high growth company. And so again, let's take a look at a similar chart that we have here. Let's take a look at the chart of NIO first on the stock chart here for you. As you can see, it's been in a clear downtrend, and it's had these rallies, and it continues to fail and hit lower lows. We're at that downtrend line right now, so we'll see what it can do at $20. But I think it's off the low. I don't think we break below 12. I mean, we're already up 67%, 65% or so from the low, the intraday low. So if I take a look at NIO and take a look at their earnings, or sorry, revenue and stock price, very similar, folks. As you can see here, continues to move higher through the pandemic and expected to continue to really explode. 2021 revenue about 5.8 billion or so. Now looking at just 2 years, 15.77. By 2024, I don't have it on this chart, but it's expected to be over $21 billion. And again, look at the price per share as this has been going on, creating a great value in a good area to start thinking about the stock, in my opinion. The next one's also a big company, and this is Next Era Energy, symbol NEE. It's about a $157 billion company. They are the owner of Florida Power and Light, FP&L, and about 60% of their operating earnings come from that. They have about over 5 million customers in Florida. They do natural gas, nuclear, solar, wind, big exposure to renewable alternative energy, which is good. As a dividend of about 2.1%. You take a look at its PE ratio, 26.4, price of sales, 6.7. So it's actually a little high for me. But again, let's take a look at the chart and show you what's going on here. I've always liked this stock because of its big exposure to solar, wind, and nuclear, which I think are going to be extremely important in the next decade plus. It's had a big rally back, but again, can it hold? Because it had a rally here, fell, rally here, fell, another rally. And again, I don't know. But again, the $67 low that it hit, to me, I think that is probably the low that's going to be in for this cycle. So let's take a look here at their revenue. Their revenue is choppier. They kind of have these ups and downs. But look at this with the expectations from 17 up to 20, nearly 25 in the next 2 years. And the stock price, again, sideways as this is expected to go up. It should catch up to it as it tends to typically do. And you will see this stock move higher with more exposure to renewable energy. We got two more here for you. Next one is, again, another big one, $119 billion company. This is Caterpillar, symbol CAT, C-A-T. We all know Caterpillar. I don't think, big construction vehicles. What I like about it is they really are moving towards automation, automated mining vehicles, using machine learning, artificial intelligence. It pays about 2% dividend. Much better value. PE ratio of 15.3, price of sales of 1.9. We'll take a look at the chart here of CAT. And there's CAT right now. And it's actually held up much better than the overall market. So far this year, it's actually up with the market down double digits. And it's been choppy at best, but it has been holding up pretty well. But again, what's important here is let's take a look at this revenue. And again, choppy revenue, but expected to take back off in the next couple of years up to about $62 billion. And as the price has been going sideways, this should continue to move higher with the stock. But again, this you take a look back and it's had pretty consistent revenue growth over the last several decades. Stock obviously going up with it at the same time. And then the last one I'm going to take a look at is Bentley Systems, a bit smaller of a company. Symbol is BSY. It's a $10 billion company. They make software, but particularly for the engineering and architectural world, which I think even though people are thinking the economy is slowing down, you're going to continue to see infrastructure build out throughout the world. And software is a great place to be. Very small dividend of 0.34%. Little pricey, but it's got some nice growth. P ratio of 39, price of sales of 8.1. And let me show you the chart here of BSY. And as you can see, had a big sell-off in May. It came down around $27, back up to 35 and change. Again, I just don't think we go below that 27. I think we've had that bottom in. I think that is your ultimate downside down there. And I don't think we fall below it. Take a look here at the revenue, folks. As you can see, big revenue growth going here from about 900 million last year. 2 years from now, 1.246 billion. And look how the stock price has gone lower, even though volume or revenue continues to move up. So this is really kind of what I've been looking at here, looking for companies that continue to have really solid top line growth. You want to have bottom line growth too if it's making money. Some of these aren't making money yet. These happen to me, but some aren't. NEO is not till 2024, and a couple others. But want that path to profitability, which they have. So when I look at this, we want to continue to see the fundamentals do well, because when this market pulls back like this, nearly everything pulls back outside of energy. We know why energy is going up. Obviously, Ukraine and higher commodity prices. Take that out, the market's really down, all other sectors. And as they pull back, but revenue continues to go higher, you want to find those companies that are standing out and doing very well. And that's the way, folks, you make money long term in the market. Use this opportunity as a time to buy, a pullback to buy. So again, thank you so much. I know normally I go a few minutes longer, but my back is seizing up right now. So I'm going to call it quits here for the show and get on the floor and lay there and hopefully stretch it out. But thank you so much for watching, everybody. Again, the next week and a half or so, I'll be down here in Nicaragua, and we'll be doing a show live from here. Thursday, don't forget, Thursday morning, CPI, big inflation number. It will have an effect on the market. I will jump in. We'll talk about that. I'm going to tell you a story about my driver who picked me up at the airport the other day in Managua to bring me here, and about inflation down here in Nicaragua and what's going on, and really that we're not alone. It's everywhere, but a pretty fun story. I'm going to talk about that. So all that and much more coming up next Thursday. Again, thank you so much for your support. Thank you so much for watching. Have a wonderful next few days. We'll see you on Thursday. I'm Matt McCall, and that was Making Money.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.